Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, today we are diving deep into a topic that is absolutely critical for anyone in global business or investing. We're talking about IFRS versus US GAAP. But we're going to zero in specifically on how they handle financial instruments.
Ever wonder how the same exact company doing the same business can publish financial statements that look, well, different? It sounds kind of crazy, right? The secret sauce, or maybe the source of the confusion, is which accounting standard they follow. And believe me, this isn't just for the accountants. These differences can totally change how healthy a company looks on paper. So let's get into how this actually works.
Okay, here's the game plan. First, we'll hit the big philosophical divide. Then, we'll see how that affects classifying debt and equity, how things are valued, and when losses get booked. We'll even tackle the wild world of hedging, and finally, we'll tie it all together to see the real-world impact. Let's do it. So before we get into the nitty-gritty rules, we've got to start right here. This is the absolute core of it all, the fundamental philosophy behind each set of standards. You can think of it like the operating system, or the source code that controls everything else.
So first up, US GAAP. The best way to think about it is like a super detailed recipe. It tells you exactly what to do. Use 250 grams of flour, bake at 180 degrees for exactly 28 minutes. The whole point is to remove any guesswork, so no matter who follows the instructions, they end up with the exact same cake. It's all about consistency.
Now, IFRS is totally different. Imagine instead of a recipe, a master chef just tells you, hey, make me an amazing dessert using chocolate and fruit. There are no step-by-step instructions. Instead, you get broad principles, like, make sure the flavors are balanced. Think about the texture. It trusts your professional judgment to get the job done right. The focus is all on the economic substance of what you're doing, not ticking off a list of rules. And this slide just nails that difference, right? US GAAP is all about a checklist. Did you meet criteria A, B, and C? Okay, then do X. It's very black and white. IFRS, on the other hand, asks this much bigger question. Does what you're doing actually show what's happening with the money? This split, this rules versus principles thing, is not just some boring theory. It's the key that unlocks why everything else we're about to talk about is so different. All right, so how does this big philosophical idea actually play out in the real world? Well, we see it right away in one of the very first, most fundamental steps, just figuring out what a financial instrument even is. Let's take a classic case, a convertible bond. Think about it. It acts like debt, right? The company has to pay interest and eventually pay it back. But it also has a feature of equity, because it can be converted into the company's own stock. So, which one is it? A liability, or is it equity? As you can probably guess, US GAAP and IFRS don't quite see eye to eye on this. And here's where you can really see those two philosophies in action. IFRS is super focused on one core principle. Is the company legally on the hook to pay out cash? If the answer is yes, then that part is a liability. Simple. That's why IFRS makes you split the convertible bond into two pieces, a debt component and an equity component. But US GAAP, with all its detailed rules, usually just lumps the whole thing together as debt. And then it creates this special in-between category called mezzanine equity, which, by the way, is a concept you will not find anywhere in IFRS. It's either debt or it's equity. Period. Okay, so we've figured out what something is. Now for the next big challenge. What's it worth? How do we put a number on it on the balance sheet? And maybe more importantly, when do we have to face the music and recognize the loss? This is where things can get really different, especially when it comes to timing and how much the numbers jump around. Yeah, they don't even start in the same place. Under US GAAP, the first question is all about the legal form. Is this thing a security or is it a loan? Depending on your answer, you go down one path or another into categories like held to maturity or available for sale. IFRS, it couldn't care less about the legal form. It asks two totally different questions. One, what's our business model? What are we planning to do with this asset? And two, what do the contractual cash flows actually look like? This focus on what the company intends to do is a massive difference. Now let's talk about recognizing losses, what the accountants call impairment. This is a big one. Both systems have actually moved to a much more forward-looking model. It used to be you'd wait until a loss actually happened. Now the idea is to recognize losses you expect to happen. It's a huge shift towards being more proactive. But, and you saw this coming, even though they agree on the basic idea, How they put it into practice is worlds apart.
And it all comes down to timing. Under US GAAP, they have something called the CCL model. And what that means is the second a company makes a loan, bam, they have to recognize all of the credit losses they expect over the loan's entire lifetime. Right away. It's a massive upfront hit. IFRS, however, uses a staged approach. On day one, you're only booking the losses you think will happen in the next year.
So here's how that IFRS model works. Everything starts out nice and easy in stage 1, where you're only worried about the next 12 months of losses. But if that loan starts to look a little shaky, if the credit risk gets significantly worse, then you get bumped up to stage 2. And that's when you have to recognize the full lifetime losses. It's a step-by-step process, which can mean losses show up on the books much more slowly than that day one punch you get with US GAAP.
Okay, buckle up because now we're getting into one of the trickiest parts of accounting, hedging. You can think of this as a company's insurance policy. They use financial tools to protect themselves from bad stuff happening, like interest rates suddenly shooting up or a foreign currency crashing. The accounting is super complex because you're trying to make sure the gains or losses on your insurance line line up perfectly with the thing you're trying to protect.
And what do you know, that same old theme pops up again, principles versus rules. IFRS is way more flexible here. It lets companies hedge more types of risk, and it doesn't have a rigid mathematical test for whether the hedge is working. It's more about proving there's a real economic link. US GAAP, true to form, is stricter. And here's a weird one. Under US GAAP, a company can just decide to stop using hedge accounting whenever it wants. Under IFRS, you can't do that if the reason you started the hedge in the first place is still there.
Okay, I know that was a ton of technical stuff. So let's get to the real question. So what? Why does any of this actually matter to an investor or anyone just trying to understand a company? Well, it matters a lot because all these little differences add up to a huge impact on the final story a company's numbers tell. Here are the bottom line impacts you have to know. First, earnings can be a lot more volatile or jumpy under IFRS. Second, a company's debt-to-equity ratio, a huge indicator of risk, can be totally different depending on which set of rules they follow. Third, because of those impairment models, the timing of when losses hit the income statement is completely out of sync. All of this means that if you're an analyst trying to compare a US company to a European one, you are absolutely not comparing apples to apples. You have to make some serious adjustments. And one last thing to keep in mind. This is a moving target. The people who write these rules are always tweaking them, always working on them. And they do talk to each other. There's this ongoing effort called convergence to try and bring the two systems closer together. But as we've seen today, some really big fundamental gaps are still there. Which really leaves us with the million-dollar question, doesn't it? In a world where money zips across the globe in seconds, does it really make sense to have two completely different languages for business? Should we have just one global standard for everyone? There are really strong arguments on both sides of that debate, and it really makes you think about the best way to tell the true financial story of a company.